We will be looking at fair value of consideration transfer by parents, which is also the cost of investment. What is fair value of consideration transfer? It is the consideration that is furnished by the owner of parents to the owner of subsidiary for acquiring the equity capital in the subsidiary. For acquiring the equity capital in the subsidiary, we have to pay for what we acquire, and most time when we are paying, it is not necessarily by only cash or through bank. There are various ways with which we can furnish the consideration, but the first one, which is the commonest one, is through cash. For acquiring the shares in another entity, we pay them cash. The next one is share exchange. It is possible that the owner of parents give the owner of the subsidiary some shares in exchange for their own shares in the company. And another one that is common is loan note. I can acquire the equity capital in the subsidiary issuing a loan note to the existing owner of the subsidiary. Another one that we have is deferred consideration. And what do we mean by deferred consideration? We said this is any payment that the parent company will pay after a predetermined period of time. This is easy. The parent company can tell the owner of the subsidiary that they will be paying additional money in the future, which may be in a year's time, in 2 years' time, in even more than 2 years' time. So any money that will be paid in the future, we refer to it as deferred consideration. And how do you account for deferred consideration? Whenever we have deferred consideration, because of the fact that if I want to pay you 10 million in 10 years' time or in 5 years' time, because of the time value of money, 10 million in 5 years' time is not the same thing as 10 million today. Whenever we have deferred consideration, that is why we need to discount to its present value. And how do I discount to present value? We use the formula amount divided by 1 plus r raised to power n. So we have to discount any amount to its present value using this formula. And after I have discounted to present value using this formula, what will happen next? At the end of every year, deferred consideration need to be unwind that interest at the end of every year, so that by the time I want to pay that money in the future, I will have the exact amount to pay you. And if I unwind at the end of every year, I add this to the initial figure of deferred consideration to get the amount which will be in my account at the end of the year. And after that, another consideration we can have is contingent consideration. Most time we find it difficult to differentiate between deferred consideration and contingent consideration because they mostly look alike. We said contingent consideration is the amount to be paid by the parent to the subsidiary which is dependent on a particular future event. So which means that contingent consideration is any amount that will be paid to the owner of the subsidiary in the future based on occurrence or non-occurrence of certain event in the future. Which means that this one too, I want to pay you in the future, fine. If I want to pay you in the future, but it is now attached to a particular condition. For example, now I can say that if you make a profit of 100 million within the next 2 years, we are going to give you additional 6 million. So which means that if you make that profit, we will give you 6 million. But if you cannot achieve the profit target of 6 million, we won't give you. Unlike deferred consideration, which must always be paid because the payment is not based on a particular condition. Contingent consideration is any future payment or future share exchange that is based on occurrence or non-occurrence of a particular event. And how do you value contingent consideration? We are told to value using the best estimate. For most time, we will be given the figure to use for contingent consideration. After that, the next question I ask is, how do I account for all this consideration? For cash, very easy. Mostly in examination condition, cash will already be accounted for already. But what about if the cash is not accounted for? What do? I get the amount, I debit my investment in subsidiary, and I credit my cash. What about loan notes? Same thing. Most time it will have been accounted for, but if not, what do? I debit my investment in subsidiary and I credit my loan notes. After that, we look at share exchange. Share exchange can be a little bit tricky. And why? If the parent company perform a share for share exchange to value the shares of the parent company, we don't use the nominal value, we make use of the market value. And realistically, we all know that market value will be higher than the par value. What will be the impact of this in the account? 3 accounts will be affected. I will calculate the total amount, I will debit my investment in subsidiary, but I will be crediting 2 accounts. Why? Because what comes to my share capital account is only the portion which is nominal value. So if I issue 10,000 shares to the owner of the subsidiary for 4 naira, for example now, but my nominal value is 1 naira or $1, what will I do? I will just say that 10,000 shares multiplied by $1, because that is my par value. That will come to my share capital. But we said share premium is any excess over nominal value. So if I issue that shares at 4 naira, whereas the par value is 1 naira or $1, automatically my share premium is going to be $3. So I will just say $3 multiplied by 10,000 shares. That is what will come to share premium. So it means that the ordinary share aspect goes to share capital, while the profit element goes to share premium. Aside from that, we can have contingent consideration. If it is not accounted for, once we get our figure, I debit my investment in subsidiary and I credit my contingent consideration. And lastly, we have our deferred consideration. We said deferred consideration, we have to discount to present value, and after I have discounted to present value and I got my original answer, what do? I debit my investment in subsidiary and I credit my deferred consideration. Now at the end of every year, we said we have to unwind. If I'm preparing consolidated statement of financial position, I am going to debit my retained earnings. Why? Because the retained earnings is the account that is representing the profit or loss in statement of financial position, and I credit my deferred consideration for that element of unwinding of interest. Let's look at some example. Question 1. Check has made an acquisition of 100% of the shares in Prague. The consideration that Check gave for the investment in subsidiary Prague comprised 1. Cash. Check paid $25,471 to the shareholder of Prague. 2. Shares. Check issued 10,000 shares to the shareholder of Prague, each with a nominal value of $1 and a market value of $4. 3. Interest-bearing loan note. Check issued 5,000 10% loan note to the shareholder of Prague. 4. Deferred consideration. $20,000 is to be paid 2 years after the date of acquisition. The relevant discount rate is 10%. 5. Contingent consideration. Further monies may be payable at a later date, subject to performance targets being met. The fair value of this consideration is $38,000. At the date of acquisition, Prague had a net asset of $80,000. Required: determine the fair value of consideration that Czech has given in buying its investment in Prague. Type of consideration can be 5, and in this question, all the 5 are present. The first one is quite straightforward. So coming to this place, we are told that cash, we paid a cash of 25,471. No adjustment, straightforward. Now coming to the second one, the question says we issued 10,000 shares to the owner of the subsidiary, and whenever there is share exchange, if you check here, we are given the nominal value of the shares to be $1 and we are given the market value to be $4. Now what we use to value shares is the market value of the parent shares. So in this place, the market value of the parent company shares is $4. So multiply by 10,000, which give us 40,000. And also the third one says the interest bearing loan note is $5,000. Coming here, that is $5,000. Now the next one is deferred consideration. We said whenever we have deferred consideration, we have to discount it to its present value. Now it says that deferred consideration 20,000 is payable in 2 years time, so which means that I need to discount. So 20,000 times, what is the percentage? The percentage here is 10%. The rule says that 20,000 multiplied by 1 plus r, which is 10%. 1 plus 10% will give us 1.1 raised to power number of years, which is -2, is going to give us a total of 16,529. We are done with the fourth one. Moving to the last one, contingent consideration. Contingent consideration in this case is already estimated for us to be 38,000, but at times they can give us some metrics to calculate it, but every time we use the best estimates to determine our contingent consideration. And in this case, because it is given to us free of charge, I will come here, that is 38,000. So it means that in this case, the parent company furnished 5 different types of consideration to the subsidiary company, and the total fair value of consideration transfer is 125. That will be the end of requirement 1. And what is requirement 2? Requirement 2 says that determine the goodwill arising on consolidation of Prague in Czech group accounts. Now we've been preparing goodwill before. It is something very simple. To determine my goodwill, I need the fair value of consideration transfer by parents, and as you can see in workings 1 here, we've calculated it to be 125,000. Bringing it down, the fair value of consideration transfer by parents is 125,000. But don't forget, as we are told in this question at the beginning, we are told that Czech has made an acquisition of 100% of shares in Prague. This is a wholly owned subsidiary. So if this is 100% holding company, automatically there won't be non-controlling interest. My non-controlling interest is nil. So adding it together give me 125,000. Don't forget, we normally less our net asset of subsidiary at the date of acquisition, and it is given to us in this question that at the date of acquisition, Prague have a net asset of $80,000. So in this case, coming here, net asset of subsidiary at acquisition $80,000, giving me my goodwill to be 45,000. And that is the end of requirement 2. Going to requirement 3. Requirement 3 says that what is the subsequent accounting for deferred consideration? We said whenever we are accounting for deferred consideration, we discount it to present value to get the amount which we have to put into our computation, and at the end of every year we need to unwind that deferred consideration, which serve as our finance cost. And as calculated in this place, my deferred consideration is 16,529, which is this. And don't forget, we discounted this using 10%. So it means that if this is the amount, at the end of every year we have to unwind the interest element on it, which is 10%. 10% on this will give me 1653. So it means that at the end of year 1, if I'm consolidating at the end of year 1, it means that I must unwind 1653. And what do we say we do to unwind? you debit your retained earnings and you credit your deferred consideration. So which means that at the end of year 1, what will goes to my statement of financial position will be 18,182. But if it is at the end of year 2, bringing this forward to year 2 will be 18,182. If I am consolidating at the end of year 2, it means that I have to unwind the cost again at the end of year 2. So bringing my total deferred consideration back to 20,000. You can see we are told that we are going to pay them in 2 years time, and when the 2 years time comes, we must have unwind, and the figure will give us the exact amount that we want to pay back. Very easy. So if it is at the end of year 1, what you do is this figure, you debit your retained earnings with that, and you credit your deferred consideration. If it is at the end of year 2, again this same figure for year 2, you debit your retained earnings and you credit your deferred consideration, which makes your deferred consideration at the end of year 2 back to 20,000. And for the last one, we are told that what is the subsequent accounting for contingent consideration. Very easy. We define contingent consideration as the consideration that is going to be furnished in the future based on occurrence or non-occurrence of certain event. Now, if the event happen in the future, the company have to pay the money. But if the event they actually agree on did not happen in the future, what will happen? Very easy. It means that the company won't have to furnish that consideration. So in this case, we are told that what will be the accounting for contingent consideration on the basis of performance targets were not met. So if performance targets were not met, it means that that liability will now be classified back as our income, because we are not paying any money again. So that liability we have recognized initially have to be reclassified back as our income. And in your statement of financial position, which account is representing income? It is your retained earnings. So what do? I will credit my retained earnings and I will debit my contingent consideration, making contingent consideration to be 0. Same thing too. What about if the performance is being met in the future? It is easy. It means that we have to furnish that consideration, and if we want to pay that in the future, we may decide to pay it through cash or through bank. So if we are giving them check, what do? Money will be going out. You credit your bank account and you debit your contingent consideration, still bringing your contingent consideration to 0. That is very easy. So let us look at more comprehensive question in our next example. So for second question, John PLC, the statement of financial position as at 30th June 20x8 are given below. We have John and we have Akin. We are given property, plant and equipment. We are given the investment, current asset. We are given the share capital, the share premium, retained earnings, non-current liabilities, and the likes. John PLC acquires 60% of Akin Limited on 1st July 20x7 when the retained earnings of Akin were $5,800. John paid $5,000 in cash. John also issued 2 $1 shares for every 5 acquired in Akin Limited and agreed to pay a further $2,000 in 3 years' time. The market value of John's shares as at 1st July 20x7 was $1.8. John has only recorded the cash paid in respect of the investments in Akin Limited. Current interest rate are 6%. John Group uses the fair value method to value the non-controlling interest at the date of acquisition. The fair value of non-controlling interest was $5,750. Required: prepare the consolidated statement of financial position of John Group as at 30th June 20x8. So don't forget, when we are doing a full consolidation question, we said we have 5 basic workings. And what are the 5 basic workings? we determine our group structure, we calculate our net asset of subsidiary, we determine our goodwill, we calculate our non-controlling interest, and we determine our group retained earnings, and other workings can join. So let me start from the first one. I need to determine my group structure. This question made it very easy. We are told here that John acquired 60% of Akin Limited on 1st July 20x7. So the parent acquires 60% of the subsidiary. Which date? 1st July 20x7. And today is 30th of June 20s8, which means that we acquired this company 1 year ago. So that is all I need. If the parent acquires 60% of the equity share capital of the subsidiary, it means that non-controlling interest is 40%, because we said non-controlling interest is the portion of the equity capital owned by another shareholder aside from the parent. So if the parent owns 60%, NCI is 40%. So after that, we move to workings 2, which is to determine the net assets of subsidiary. And it is easy. What do? I come to this place, the equity aspect of this place, and I am concerned about subsidiary. What is the share capital of subsidiary? 5,000. And what is the retained earning? 7,200. Because today is the date of reporting, I will come here 5,000 and 7,200. But don't forget, coming to this place, we are told that John PLC acquired 60% of Akin Limited 1st July 20x7 when the retained earnings of Akin were 5,800. So which means that at the date of acquisition, the retained earnings of Akin was 5,800. That is why my retained earnings here at the date of acquisition is 5,800. Subtracting date of reporting and date of acquisition will give us our post acquisition. So 72 minus 5,008 give us a post acquisition of 1,400, and that is the end of workings 2 in this case. If I'm done, what do? I have to move to workings 3, which is the determination of goodwill. And how do we determine goodwill? We know that to determine goodwill, we need to compute fair value of consideration transfer by parent. So the first thing is, let me check this question. What are the fair value transfer by parent? Coming to this question, we are told that John paid cash of $5,000. So coming here, cash paid, simple and straight, 5,000. John also issued, look here, John also issued 2 $1 shares for every 5 acquired in Akin Limited. Now we have to pay attention here. The first question is, how many shares am I getting from Akin Limited in the first place? I want to get 60% of the total shares in Akin. So if I have $5,000 here and the dollar is $1 each, so it means that the total shares available in Akin is 5,000 shares. That is the total shares available. So I want to get 60% of that share. So automatically I know the number of shares I'm getting. But don't forget, we only want to give them 2 for every 5 we get in that company. That is why we come to this place. The question says John issued 2 $1 shares for every 5 acquired in Akin Limited. So which means that we give 2 for every 5 acquired. Sometimes they may tell you we give 1 for every 3. So that is the exchange ratio that we come here. So our exchange ratio in this case is 2/5, because John give 2 shares for every 5 acquired from Akin. And don't forget, I told you whenever we are dealing with share exchange, we multiply by the market value of the shares of the parent company. We are given in this question that the market value of John's shares is 1.8. So that is what comes there. So what normally comes here is the market value of the parent shares. Coming again, I want to acquire 60% of the total shares in the subsidiary, which is 5,000 shares. I multiply by the exchange ratio, which is 2/5, because I'm giving 2 for every 5, and I then multiply by the market value, which is 1.8, which is very easy, give us 2160. And after that we go to deferred consideration. And without forgetting how to treat my deferred consideration, we said deferred consideration, we discount it to present value. Very easy. And in this question we are told that interest rate is 6% and we want to pay 2,000 in 3 years time. Pay 2,000 in 3 years time, I need to discount it to present value. That is 2,000 here multiplied by 1.06 raised to power what? -3, because we want to pay it in 3 years time, giving us a total of 1,680. And adding these three together, it means that the total fair value of consideration transferred by parents is 8,840. And what do? Fair value of consideration transferred by parents, add what? Non-controlling interest. And non-controlling interest in this question is given to us free of charge, that our non-controlling interest is 5,750. Coming here, non-controlling interest as given in the question, 5,750. And after I've gotten that, what do? Don't forget, we always less net asset of subsidiary at the date of acquisition. And where can you get your net asset of subsidiary at the date of acquisition? We've calculated that in workings what? 2. Coming back to workings 2, what is my net asset at the date of acquisition? That is 10,800. So I can come here and input it here. Net asset of subsidiary at date of acquisition is 10,800, which give my goodwill to be 3,790. That is all for workings. We move to workings 4, which is non-controlling interest as given in the question, 5,750. And don't forget, the non-controlling interest have to take part of the post-acquisition profits, and since the parent company owns 60%, they own 40% of the business. So 40% multiplied by my post-acquisition profits, which is 1,002, give me 560. Adding it together give me 6,310, and that is the end of workings 4. I can move to my workings 5, but before I can do my workings 5, I have to quickly go to workings 6, which is my deferred consideration. We are told that we have to discount our deferred consideration to present value, and according to what we did here in workings 2, we can all see that we calculated our deferred consideration to be 1680. But don't forget, we said at the end of every year deferred consideration have to be unwind. So to unwind 1680, what I need to do is 6% times 1680, because the interest rate we used to discount this figure before is 6%, giving me 101. So if you get your 101, what is the double entry? I already said it. You have to debit your retained earnings and credit your deferred consideration. That is why I come to this place, I add it here, 101. At the end of the day, when I'm consolidating, I'm going to consolidate 1781 at the end of this year. But look at this place, the same amount comes here as a deduction because it is a cost, which is a finance cost, which will be a charge against profit. So whenever you unwind your deferred consideration, you less it from your retained earnings and you add it to your deferred consideration figure, giving us a total of 1781. So when I'm consolidating, I'll be bringing this figure in. So let us come back to workings 5. What is the balance brought forward of retained earnings? As given in the question, the retained earnings is the one for the parent company, and parent company in this case have a retained earnings of 12.5. I bring it forward, 12.5. And don't forget, any post-acquisition profit in the subsidiary company, the parent will be entitled to 60% of it because it owns 60% of that company. So Coming to this place, 60% of post-acquisition profits, which is 1,400, gave us 840. That is how our retained earnings at the end of the year is 13,239. And before I go, I need to explain share exchange. Now, in this case, we all see that this company is definitely getting 60% of the equity capital. The question is, how many shares will I be giving them in total? So that will be 60% of 5,000 times 2/3, which means that the total shares the parent company will give the owner of the subsidiary is 1,200 ordinary shares. Coming back here, let me take you back a bit. Coming here, before I value this, 60% of 5,000 times the exchange ratio, which is 2/5. Doing this 3 without multiplying it by the value here is going to give us a total of 1,200 shares. So which means that we want to give the subsidiary 1,200 shares. But don't forget, share capital can only be recorded at its par value, which is nominal value. So that is why we'll come here. What is the par value of this company shares? Coming to my account here, the par value is 1. If it is 1, so I multiply by $1 times 1,200, giving me 1,200. But you will now ask me, but when we were doing the real valuation, we use 1.8, not 1. Yes, because the any extra or any excess on the nominal value whenever we issue shares will be treated as share premium. So that is why the balance that remains, that is not accounted for here, which is 0.8, will be treated to share premium. And what will happen to my share premium? I will say that is 0.8 multiplied by 1,200 shares, which give me 960. So which means by the time I'm consolidating, I will credit my share capital with additional $1,200, and I will credit my share premium with additional $960. And those are the workings required here. How will the consolidation looks like? So let us go to how the consolidation will look like. So what is the first thing? Based on our previous knowledge, you add all the assets together, all the liability together. So coming to this place, property, plant and equipment is given to be 15,095. Coming here, 15,095 give us a total of 24,500. Now, as calculated in note 3, our goodwill as gotten in note 3 is 3,790. I bring it down here. And don't forget, whenever, now look here, we have to be careful here. Investment in Akin, which is the subsidiary, in this case is 5,000. Now we need to confirm something based on our calculation in workings 3. We can see that the total fair value of consideration transfer is 8,840. But coming to this place, the only investment you can see here is 5,000, but we are using 8,840 here. Why? Because they told us something in this question. Let us check again. They said John paid 5,000 in cash. He also issued shares, but they now said something. John has only recorded the cash paid in respect of the investment. So which means the share exchange has not been accounted for before. The deferred consideration have not been accounted for before. The only thing that was accounted for in this investment, the reason why it is showing 5,000 is because the only thing they've accounted for before is the cash of 5,000. So, but all in all, what do we do to any investment in subsidiary? We don't consolidate it. So this 5,000 won't come into account at all. So I move to current asset. What is my current asset? I have 7,500 and 5,000. Coming here, 7,500 and 5,000 give me a total of 12,500. and my total assets will be 40,790, and that's all. I can then go to my equity aspect. For my equity aspect, I say this in my every video: when you are consolidating, you don't consolidate the share capital of the subsidiary. The only thing that comes here is the share capital or the equity of the parent company alone. So the equity of the subsidiary won't be consolidated. So what will happen? I will come here, my share capital is 6,000. I will come here 6,000, but don't forget, we calculated in working 6 that the additional shares the parent company will issue to the subsidiary company will cost them a nominal value of 1,200. So I will come here, 6,000 plus 1,200 credits. That is what gave us a total of 7,200. The same thing too. What is my share premium here? 4,000. Bringing it here, 4,000. As calculated in note 7, we are told that the proportion of the new shares issued to the subsidiary will generate a share premium of 960. Adding it together give me a total of 4,960. And according to our calculation, which is our note 5, we have gotten our retained earnings in note 5 to be 13,239, which we can confirm here. In our note 5, my retained earnings is 13,239. So coming back here, so giving me a total of this. So if this is my total, what is the next thing? I add my non-controlling interest. And don't forget, my non-controlling interest is calculated according to note 4. So I can go back to my note 4 and get my figure, which is 6,310. So going back up to confirm that figure, my note 4 is 6,310. That is what I brought down here to consolidate, which is 6,310. So our total equity will be 31,709. After that, we can then move to non-current liability. What is our non-current liability? We have 1,000 and we have 500, which is this and this, which is 1,500. Don't forget, this question told us that they've not accounted for share exchange, they've not accounted for deferred consideration. That is why when I'm accounting here, I brought the 1,2 and the 960 here for share exchange, and they've not accounted for deferred consideration too before. I have to bring it into consolidation. So as calculated in my working 6, we calculated our deferred consideration to be 1781, which can be confirmed here, which is my deferred consideration after I have unwounded my finance cost, give me a total of 1781. Brought down here, giving us 1781, and other liability, other non-current liability is 15. Same thing too, I can go to my current liability, which is 4,018. Adding it together here gave me a total of 5,800. So therefore, my total liability, adding this and this together, it was a total of 9081. And what will be our total equity and liability? My total equity and liability will then give me 40,790, which make this account balance.